There are three reasons why we should consider investing in Chevron Corporation. First, it's a super investor stock, owned by 6 super investors, led by Warren Buffett's sizable $23 billion position. Second, Chevron is a dividend aristocrat, which means it's an S&P 500 company that has increased its dividend for more than 20 years. In Chevron's case, it's actually for over 35 years. Last but not least, Chevron is one of the 5 oil majors, and through investing in it, we can diversify our portfolio to the commodity market, which will outperform in the face of a prolonged inflation. In order to help you make a better decision, this video will break down Chevron's business, as well as why some bulls love it, while some bears avoid it. Chevron is an US-based multinational energy company created as one of the spin-offs from the legendary Standard Oil Company. Led by John D. Rockefeller, Standard Oil once had a monopoly of the oil industry, but was eventually broken apart by the US government because it had too much economic power. However, even after the breakup, Chevron grew quickly by partnering up with the major players like Texaco and played a key role as one of the 7 sisters that dominated the petroleum market until the oil shock in the 70s. Chevron is currently the 4th largest petroleum company in the world, only after ExxonMobil, Shell, and TotalEnergies. But if we include state-owned enterprises such as Saudi Aramco and China's Sinopec and PetroChina, Chevron ranks in the 7th place. Chevron is an integrated oil company, which means it engages in various activities spanning from crude oil and natural gas exploration to refining, marketing, chemicals manufacturing, basically all the way from getting the oil out of the ground to selling fuels at gas stations. In its 10-K filing, the management categorizes Chevron's activities into 2 segments, upstream and downstream. Let's first look at the upstream segment, which handles the exploration, development, and production. Chevron currently produces about 3 million barrels per day out of global crude demand of about 100 million barrels per day, representing 3% market share. Although its oil and gas reserves are located all over the world, about 2/3 of the crude are in the US. This is important because given how geopolitical risk is rising around the world, from the Russia-Ukraine war to China-Taiwan tension, having reserves in safe, stable region will matter a lot if the conflicts get worse. In this risk-aversion perspective, the fact that Chevron has about 80% of oil reserves in relatively safe regions, such as Americas and Australia, is definitely a plus. Such US-centric production will continue in the future, because 75% of new drilling activities are still happening in the US. For those who are interested, you can check out more details of Chevron's E&P activities in various regions, starting in Annual Report page 10. The downstream segment is further divided into 5 operations. The first, refining operations, can process up to 1.8 barrels per day through its 8 large refineries. 5 of them are located in the US, and 1 each in South Korea, Singapore, and Thailand. The 5 large refineries in the US are especially important because due to ever-tightening environmental regulation, it's now almost impossible to build any new refinery in the US. For example, no new refinery was built here since the 1970s. And while the demand for petrol products continued to increase every year, the total number of refineries in the US decreased from 250 about 3 decades ago to less than half now. Like what Carl Icahn said in a recent interview, increasing demand and limited new supply are going to benefit the existing refineries, Chevron included, over the long term. The second downstream segment is marketing operation that sells petroleum products under the brands of Chevron, Texaco, and Caltex. In the US, the company has about 8,200 gas and service stations. Most of them are franchised out, and only about 300 are directly owned by Chevron. The third, chemicals operation, develops and manufactures various lubricants and fuels. Chevron used to break down this operation's financial performance separately until 2007, but since 2008, it's combined into the downstream segment. This shouldn't be a big issue because it only contributes about 2 to 3% of overall profit. The 4th and 5th operations are renewable fuels and transportation. These operations continue to grow through R&D and through acquisitions like the Noble Midstream Partners in May 2021. But these contribute only a small portion of Chevron's overall revenue and profit. In fact, looking at the big picture, basically most downstream profit comes from the refining operation, which contributes about 20% of Chevron's overall performance, and the rest 80% comes from the upstream. The upstream's performance, in blue, is less stable, so even though the downstream is much smaller, it adds stability to the overall cash flow. When analyzing and projecting Chevron's future performance, we should mainly focus on its upstream segment, because it's not only much larger, but also has room for a wider range of outcomes to shareholders. The bull thesis on Chevron can be explained in two parts. First and foremost, bulls emphasize that Chevron has high-quality reserve assets. As mentioned previously, most critical crude oil reserves are located in rather safe areas, especially in the US. And the cash flow generated in this country will only increase in the coming decades, as the Permian Basin and other shale wells produce more. Another reason why Chevron's asset quality is high can be explained the following way. In oil and gas investing, everyone can make a lot of money when oil prices go up. Since the upside basically takes care of itself, investors should focus more on the downside. What happens if oil price remains dull or even falls a lot? And this is where Chevron's high-quality reserves shine. As we can see here, Chevron will chunk out 12% return on common equity, and cash flow will increase at about 10% per year for the next 5 years. And most importantly, this return and growth will materialize at $60 per barrel. So even if the oil price falls by a third from current $95 per barrel, shareholders can expect decent return. But there is even a better news. In September 2022, Chevron's CFO confirmed that internally, the company built its business and financial framework at a $50 per barrel scenario. This is very conservative, but even at this level, the company can maintain its dividend growth trajectory, which has been increasing for the past 35 years. And God forbid, if oil price settles at $75 for the next few years, which is about 20% drop from current price, then Chevron can buy back more shares than what it's paying out as dividends. This will significantly increase shareholder return for years to come. So to sum it up, Chevron's current share price and standing indicate a heads, I win large, but tails, I still do okay situation. The second bull thesis points to the highly disciplined management. This is especially important at an oil and gas company because in commodities business, companies cannot meaningfully differentiate their products through factors like brands or network effects. Similar to financial companies, what ensures an energy company's long-term success is what the managers do with current cash flow today, which will manifest many years later. Of course, the difference is that while financial companies like banks or insurance companies invest in equity or debt, energy companies invest in oil fields and natural gas projects. So how does Chevron perform in this perspective? Over the past 3 decades, the company generated 16.4 return on invested capital. This number in itself is satisfactory, but compared to its peers, Chevron's ROIC is the second highest among the top 5 oil majors. And this result is achieved while having the lowest asset write-offs. Write-offs occur when a company recognizes that it overpaid for an asset. So the fact that Chevron has the lowest write-offs means that it invests in a disciplined manner. In addition to such numerical evidence, now let's look at what the management is saying about its financial priorities. The first is continuously increasing its dividends. As mentioned previously, Chevron lived up to this commitment for the last 35 years. And compared to its peers, Chevron's achievement, shown as the blue line, shines even more. The second priority is reinvesting into the business. For example, Chevron bought into a leading position in the Permian Basin, which is highly profitable and also has over a decade of tangible growth prospect. But if you think about it, anyone can buy high-quality oil fields if you pay high price. So the key is not just buying good assets, but also purchasing at a reasonable price. Having one of the lowest write-offs in the industry is a good indicator. But now, let's look at more recent cases. When the COVID lockdown in 2020 suppressed oil demand, and oil price even touched a negative price in late April 2020. And it was definitely a difficult time to be optimistic about the energy market. However, in July of that year, Chevron surprised the market when it acquired Noble Energy, an oil and gas company with more than 2 billion barrels of proved reserves. And thanks to the market pessimism at the time, Chevron could buy Noble at only $5 billion of equity value, which implies less than 6 times EBITDA multiple. Needless to say, since oil price more than doubled, Chevron scooped up good assets at a low price. However, the management is not forever bullish about oil price. In early 2022, when the increasing demand and Russia-Ukraine war pushed oil price above $100 per barrel, Chevron made another smart acquisition, but this time, instead of paying up for a conventional oil and gas asset, it acquired Renewable Energy Group, which specializes in converting natural fats, oils, and greases into advanced biofuels. This was timely because this company's share price dropped more than 70%, from above $110 a year ago to low 30s in February 22. We will have to wait some time to see how the economics of this investment pan out, since it only closed in June. But at least for now, looking at the price chart and considering the potential synergy with Chevron's existing fuel business, this M&A at 8.6 EBITDA multiple seems reasonable. Also, thanks to this deal, Chevron is now the second largest biodiesel player in the US and the third largest in the world. Moving on, the next priority is maintaining a low leverage. This is very important for energy companies because the commodity market is very volatile and cyclical. Chevron's current financial position is quite strong, with only $13.8 billion of net debt compared to the $340 of market cap. And compared to its peers, it has the lowest net debt to tangible book value at only 15%, as well as the lowest net debt to EBITDA multiple at 0.6, all indicating a low leverage. The fourth priority is repurchasing shares, but only if Chevron has plenty of cash after taking care of other priorities. The company bought back shares 15 of the last 19 years and repurchased at an average price of $90 a share. Since Chevron trades above 170 now, the shareholders are getting a good deal out of these smart decisions. During that time, the company spent about $50 billion in total. According to the management, it can currently buy back at a rate of $15 billion per year, which is about 5% of shares outstanding. Through this graph, we can see that Chevron has remained true to its financial priorities. While making smart investments at 16% ROIC and maintaining a low leverage, it first focused on paying steadily increasing dividend, the blue portion, and returned extra money as buybacks, the orange bars. If you're not familiar with the energy market, you might take such outstanding result as granted. But if we compare Chevron's result with that of the Total Energies in France, which has much less consistent result as we can see here, and compared to the UK-based Shell here, Chevron's result stands out for sure. It's interesting to see Shell's management having some kind of identity crisis, as its CEO famously said that Shell is not an oil and gas company, but an energy company. But rest assured, Chevron's management doesn't seem to have any issues like this. As we analyzed until now, Chevron has many positive factors that Wall Street bulls love about. However, there are also 3 risk factors that you should be aware of. The first is set of tail risks involved in running such a technically challenging and environmentally impactful operations all over the world. For example, on April 2010, BP's oil rig, Deepwater Horizon, exploded and sank. As a result, 11 people were killed, 17 injured, and 4 million barrels of oil flowed into the Gulf of Mexico for 3 months. It was a tragic accident for the people involved and the nature, and BP shareholders had to pay for it. For more than 5 years after the initial accident, BP paid about $70 billion in cleanup costs, charges, and penalties. And that company still hasn't completely gotten over the event, as its still lagging market cap indicates. Although Chevron has top-of-the-class safety record among its peers, it will continue to drill all over the world, including the Gulf of Mexico, for decades. So even if the probability is low, the tail risk remains. Also, as mentioned previously, Chevron has a lot of its crude oil reserves in safe regions. However, its natural gas is more exposed to the geopolitical risk, as about 1/3 of gas reserves are located in Africa, which has low political stability, and in Asia, including Kazakhstan, which is surrounded by Russia, China, and close to Iran and Afghanistan. None of these facts means imminent trouble, but Chevron is definitely exposed to several tail risks, and so if we invest in the stock, we should look for some margin of safety. The second risk is actually more imminent, which is the looming economic recession. Whether the recession happens now or in 2023, weak economy means falling demand for oil, and hence lower oil price and profit for energy companies. Of course, if you think about this, short-term economic cycles naturally come and go. So if you invest in energy companies, in fact, for any companies for a long term, such economic ups and downs shouldn't cloud your thinking so much. But still, Chevron bears claim that this is not a good time to buy energy stocks. In addition to such short-term concern, The bears claim that the oil and gas companies also have a very gloomy long-term prospect. This is because electric vehicles will dominate the world in no time. Usually, there are two common responses to this real long-term risk. First is to never investing in oil and gas companies because they are doomed to fail sooner or later. The second response is to say, but crude oil has many other use cases, so I don't worry about the falling demand at all. The problem is that neither group is utilizing a smart thinking process. The first group is not completely right because, like what the second is saying, oil is used in various parts of our lives. So even if all cars run on electricity, there are still going to be oil demand for all these other things. But what this second group comes short on is any numerical estimate of the demand fall. And at what point in future will that materialize? Even if we can't calculate this number exactly, having a rough numerical base is very important so we can make adjustments as future unfolds. So in this regard, let's look at what happened in the early 2020 when oil demand fell due to the COVID lockdowns. In the first quarter, oil price fell from the high 60s to $18 in just 4 months and remained low near $40 per barrel for almost a year. Basically, oil price fell 72% when demand fell about 15%, and oil price remained 40% lower than the pre-COVID price because oil demand remained about 4% lower. Since even a slight drop in oil demand can have 5 to 10 times effect on the price, investors should have a good understanding of future demand outlook. Also, be able to adjust their expectations as the electric vehicle market marches ahead. To help you quantify, I ran some numbers to see how fast or slow the oil demand will fall as the electric vehicle market picks up. Some facts that went into my model were, there are about 1.2 billion cars on the road today. About 40 million new cars are added every year, and this number is growing. Although only about 10% or less of that total new cars are EVs today, I applied an optimistic market view that by 2035, all the new cars sold around the world will be 100% electric, which will look like this. As more and more EVs are added to the road, the number of conventional vehicles in orange will fall, and by 2046, all the light vehicles in the world will be electric. As a result, oil used by cars will decrease significantly over the years and reach zero by 2046. However, while the uses from vehicles fall like this, other crude oil usages such as petrochemicals, agricultural, commercial usages will continue to increase all those years. So if I apply this growth into the model as these orange bars, we can see the total demand change as EVs take over the world. What's interesting here is that the demand can actually increase for the next 11 years because it takes decades for the existing conventional cars or run out of their useful life. And compared to this year's demand, the overall oil demand will only start to fall in 2042. Having such numerical-based model can be powerful because as you can see in this chart, oil demand is quite stable over the long term. And if there are any significant changes to the oil demand in the coming years, we can adjust our model to make more rational decisions. By the way, if you want to make changes to the model yourself, you can download it at the link in the below description. So considering all these opinions from bulls and bears, I hope you can now make a better decision about Chevron. Alright, that's gonna do it for today's video, and thank you all for watching. I really do appreciate it. If this video benefited you in any way, please click the like button below and also subscribe to the channel. And I will deliver deep dive numerical analysis on companies that are chosen by super investors. Also, feel free to share your thoughts on Chevron. Are you buying it or avoiding it? And for what reasons? Is there anything else major that people should consider before making decision? Please let us know. Okay, thanks again, and I'll see you next time. Take care.